Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, it was a roller coaster week again on Wall Street. Down at the beginning of the week, a nice pickup Wednesday and Thursday, showing some hope in the market still left, but that was soon dashed on Friday with the market down right across the board, with the Dow in fact losing 250 points. Traders becoming more pessimistic about the likely news this week from such heavyweights in the financial sector as Merrill Lynch, Citigroup and JP Morgan Chase. Also, American Express card company warning that slower spending and more delinquencies from their account holders, pointing to a much weaker consumer. The rescue packages for financial institutions are starting to surface, with Bank of America on Friday agreeing to buy Countryside Financial Corp for $4 billion, a deal that rescues one of the largest US mortgage lenders, but in fact pays less than the company's market value. It's now showing real weakness going into the new year, and the importance of the long-term average line for the Nasdaq Composite Index is really coming to the fore. We'll point this out on this week's Nasdaq Composite chart. I'd like to take a look now at the one-year chart for the Nasdaq Composite Index, so we can really zoom in on this head and shoulders reversal pattern, which is the pattern that we've been predicting for some time now for the market to reverse direction, and this has in fact happened over the holiday period. It all started back in July and August of 2007, when we had the left shoulder being formed at the first breaking of the subprime mortgage problems. That news caused that sudden drop in the market and formed the left-hand shoulder, and then we had a rather nice autumn rally, certainly in tech stocks, which took the market back up again to new highs and formed the head of the pattern, which is this area here, before Christmas, where we quite accurately predicted that the market may well then form a right-hand shoulder. So we were expecting a little bit of a pickup before Christmas, and over the Christmas period it continued before falling away coming into the New Year period. And in fact the sharp drop at the end of last week, particularly on Friday when the Nasdaq on one day dropped nearly 100 points, this penetrated what was effectively the neckline. This line here is the neckline of a head and shoulders pattern that has now formed and is a very significant line to be penetrated. We do feel that there is little chance now of the price channel that was formed over the last 2 months continuing, because the penetration seems to be quite certain here. So there's less likelihood that this is just a continuation of a consolidation phase. More likely that selling will continue into the new year a bit further down, before then some sort of rally will be attempted to bring the price back up again to touch, or in fact just go over by a short measure, the neckline line here, which will then probably signify the market turning south again and falling away in a more prolonged downtrend. The market really has reached a crucial point now, because the recent market action, taking it down again on Friday, has brought it to the level of the long-term average line. This is a very important line that, if you refer back to the chart, you'll see as the upwardly sloping line just below the general market graph. It's what the market does now that is crucially important. It's already had an attempted rally last week that failed. If this line is penetrated badly in the next week or two, then I think we really are in for some rather nasty events in the stock market, and the downtrend will be steep and probably lead to a panic phase in the market. But here at Ferrari Financial, we plan for exactly this type of event, and sharp movements in the market generally give us very good profit opportunities. So this week we'll be watching very carefully to see if the market does in fact drop further, but we do feel that there is a strong chance that the market will consolidate around this moving average line level, and after some consolidation we'll attempt a further rally, because as we said before, normally you see a return back towards the neckline that we pointed out last week of this head and shoulders reversal pattern before the real downturn occurs, and then that is a more prolonged phase. The level that the market is at the moment is doubly significant because it's not only at the level of the moving average line, but it's also an important support level from previous market action over the last year or two. If it goes through this support line, then we really have got a serious down phase for the market developing. We'll be watching very carefully. So till next week, it's goodbye from London.